Hello, I'm Russell Poynton from Edison Group. Today, we're delighted to have Christoph Barchewitz, the CEO of Global Fashion Group, here again with us. We last spoke to Christoph right at the end of May, actually, when he came to speak about to get the business, give us an introduction to Global Fashion Group and what it does. Welcome back, Christoph.
Thank you.
Hope you've had a good summer.
Thank you.
So you've just reported the first half results, and there are quite a lot of things happening in the group. So why don't we start off with ANZ, where you're seeing continuing good in trends in ANZ. So could you give us an update on what you're doing in terms of engaging with your customers, improving the assortment, and just what's happening at the operational level?
Yeah, absolutely. So very pleased with the results in Australia and New Zealand, our biggest market. So obviously very important from that perspective. I think it's really a broad range of initiatives that drive, the growth, but also the continued strong profitability and year-on-year improvement. So the ones I would highlight is, the assortment in fashion is always a work in progress, but I feel really good about the strength of the assortment, the quality of the inventory, but in particular also the efficiency and the discipline around, purchasing decisions. And I think what has really helped there get us into this position is that we've balanced the business much more strongly between retail and marketplace. So some of the more risky or longer tail categories or brands are in the marketplace, and within marketplace, we're growing our fulfilled by services very significantly, which is improving the experience for the customer because the delivery for anything that comes out of our fulfillment center is just so much quicker. So that plays a role. Talking about quick delivery, we also accelerated the delivery in some of our key cities. Melbourne is really important there. Sydney has always been our home, and so we've always been great at delivery there. But we now do next day delivery for most orders in Melbourne as well. And we've seen a noticeable uptick in customer engagement and orders from that region. And we'll take that model to some of the other key cities in Australia as well. And then last not least, I think in the last year, we talked a lot about the order warehouse management system that we deployed in Australia and New Zealand, which is actually the system we've built originally in Southeast Asia. And that's now fully deployed, but we're still ramping up in some of the efficiency gains that are coming from that. So those are still not fully through the numbers. And so as we look ahead, we expect more benefit from that. And then last not least, on the marketing side, we've been really active. We had this Got You Looking banner campaign to really re-energize the brand. And that continues in its next installment. And we're now moving to a direction where we're really thinking about how we reward our most active, most loyal customers more. And there's a bit more to come later in the year. So we're looking forward to that.
Good. Thanks for that, Christoph. So let's move on to LATAM, where I think it's fair to say that the recovery is well underway. So what are the important changes in LATAM from an operations perspective and a customer perception perspective?
Yeah. Yes, I mean, we're very pleased with the results in LATAM. Double-digit growth in the first half, strong improvement in profitability. I think the scorecard there is very positive, but it's been, a couple of years in the work to get to this point. I think the biggest pieces here were really, focusing on the assortment and really driving exclusivity and very close brand partnerships with especially the largest brands. And articulating that to the customer as a point of differentiation of our platform really being the place to get the best fashion all under one roof. We also invested into the front end, launched a new app, and that is now yielding results where we see the customer experience is just clearly improved. And so customers are shopping more with us. We're back into growth when it comes to the customer base. So the results are definitely coming through. We also have launched our fulfilled by service, and that's again an enabler where we're shifting marketplace sales from a dropship model into being fulfilled from our fulfillment center, which again improves the customer experience overall and is an incremental service to our brand partners. And so I think those experiences have really helped us to strengthen the proposition in a highly competitive market. And interestingly, many of the competitors we're facing in Brazil in particular are the same competitors we're facing in Southeast Asia, or very similar in nature. And so I think there's a couple of learnings from that turnaround over the last, 2.5, 3 years in LATAM that we're now also trying to deploy in Southeast Asia as we're facing a highly competitive market in which we need to sharpen our proposition.
Good. And the third region is Southeast Asia, where I think it's fair to say the KPIs are still mixed, but you're making lots of changes behind the scenes and in what the customer's seeing. So could you again update us on what you've done there and how the customer reception?
Absolutely. So Southeast Asia is definitely fair to say that it's been the region which, it's also fairly fragmented across our 5 core markets: Philippines, Indonesia, Singapore, Malaysia, then Hong Kong is our smallest market. Is one where we've been struggling, and we're not happy with the results. We're down 18% on the NMV in the first half. But I think what I would highlight is just the level of activity and decision making, especially in the last 6 months, that we've driven in the region. So this starts with a much more disciplined approach around our assortment and really looking at what are the brands that matter to the customers, what that matter to the high value customers in particular. So the action we've taken there is we've just removed a lot of smaller brands from the assortment to really focus on what matters. We've also exited a number of small categories that just didn't drive a lot of NMV contribution, but drove complexity into the business. And we're continuing to shrink down the number of SKUs on the platform. That's ultimately the metric really to look at. And we think as a result, we have a more relevant assortment to our core customers. The proposition is sharper. And we also can deliver to our most important brand partners better sales, better volume. So even though the overall business is still declining, we have seen growth in some of the key brand partnerships. And that's obviously very, very important to build and maintain these relationships. We've also taken some difficult actions on the cost side. So our cost base is down across the board, in all countries, across all functions. Yes, that unfortunately also impacts people to some degree. So our headcount is down significantly, but we've also looked at every single spend in terms of offices, in terms of technology spend, in terms of fixed costs. And most of that action happened during the first half. So it's only really going to come through the numbers, fully in the next couple of months. And, that's something where we think there's upside. Despite all of that only being first half actions, actually both gross margin and EBITDA margin have improved year on year despite the top line decline. So I think we're very disciplined, very focused on profitability, and overall pushing for a much more focused, narrow proposition for the core customer in the region.
And all this has been happening ahead of the arrival of a new CEO. So what is on his to-do list when he's
so our new CEO, Felipe Garcia, who comes with a wealth of experience. He's been in fashion, retail, and e-commerce for basically all of his career. And interestingly, he's also worked across 3 regions in Southeast Asia, but also in the Middle East and in Europe. So he's really bringing a very broad range of experience to the table. He's very familiar with our business model. He understands that. And so I think, he will fully step into the turnaround plan that's in execution. So this is not about assessing what needs to happen next. It's more about how can we go, faster on the execution of the plan we've already set. Obviously, we always need to revisit. We always need to question the feedback from the customer and from our brand partners. But fundamentally, his mandate is to execute the turnaround with urgency, continue to look at our cost structure, but most importantly, look at the proposition to brand partners and to the customers and find ways of, improving that proposition so we can come back to growth initially, and then ultimately also drive profitability and cash flow through the turnaround.
And given the nature of your business, it takes a while for some of these things to show through in the numbers, the KPIs. So amongst all those mixed KPIs, what are you seeing that's actually, do you think, is encouraging or positive?
I think the things that are encouraging, they're always a little bit more in the detail, right? So the ones that I would highlight is basically, number one, that some of the most important brands are actually growing. And the feedback from the important brands, and this is usually the top 30, is very much that they want us around. They want us as a partner. We are the only multi-brand fashion platform, and they very clearly understand the distinction between what they can do on their brand.com, what they can do on a multi-brand fashion platform like our Zalora platform, and what they can do maybe on a general merchandiser, which is more an end of season or clearance or value-driven proposition to the customers. And so that segmentation, that approach from the brands is really reconfirmed through also my interactions with many of the brand principals in the region in the last couple of months. And then beyond that, I think what is really important is I think we have an incredibly passionate, committed team in the region that is very, very keen to actually succeed. We're very decentralized, so we have a strong presence in each of the countries. And, I've spent time in each and every market in the last 6 months. And what really comes through is a level of passion and energy from the team. It obviously needs clear direction. It needs strong alignment. It needs strong leadership. But I think with Felipe as a new CEO there, we have exactly what it takes to deliver that.
Great. Well, that's an overview of each of the three divisions. So could you bring this together at the the group level and what you saw in the first half results?
Yeah, so overall, from a top line perspective, we're, basically flat. So we've stabilized after, last year seeing an overall decline for the group. So we're also very comfortable that we are well on track to deliver the group guidance for the year. Full year numbers, we said NMV -5 to +5. So it's still a quite broad range, mainly because we're so back-end loaded with Q4 being such a strong, big trading quarter for us. I'm particularly pleased, as I said, about the ANZ and LATAM growth. Now we need SEA obviously to come back to growth as well. So that's the medium-term objective. But I think that's where we are from a growth perspective. The other piece I think we're really comfortable is our gross margin is up substantially year on year. Our EBITDA margin is up substantially year on year. So we're well on track to hit our guidance target of a break-even adjusted EBITDA for the full year. And so I think everything that we want to achieve is coming through in line with our expectations and our guidance. And I think we also feel good about the balance sheet and where we are there. Both on the inventory side, where we have a pretty clean overall inventory position. It is efficient, but also from a cash perspective, we're in good shape.
Could we just go a bit further into the cash and the net
Sure.
debt? Because your business is quite seasonal in terms of the cash flow generation. So just give some insight into the first half cash generation and where the net debt ended up. And
yeah, as you say, it is a very seasonal business, and we have always a strong cash outflow in Q1 as we pay for some of the inventory from the big Q4, and also seasonally have the least volume in the first quarter. So it's least profitable and highest negative cash flow. And then equally, the Q4 is always highly cash generative as we're trading through the peak season and take on a lot of cash from customers. So that dynamic doesn't change. In the first half, we had a normalized free cash flow outflow of 62 million euros, which is basically flat year on year. So it may look like not much progress, but I think what's very important to highlight in that is that actually the first half this year is in a much better, more sustainable shape, because the improvements that we've seen on EBITDA, i.e. improvement there, and secondly, lower CapEx and also lower lease costs, that's really sustainable and something that we see as a journey to an overall stronger profitability profile. Whereas last year we had a lot of benefit from working capital, and that's been much more modest this year. So we're shifting, the dynamics behind the cash flow there. And we're all overall still sitting on a strong net cash position. So feel very comfortable about the journey ahead as we move towards profitability this year on EBITDA, and then eventually also to cash flow break even.
Okay. Well, Christoph, thank you very much. That's a good overview of what you've been doing in the first half and the financial results. So we'll look forward to seeing you again.
Thank you so much.